In late January 2026, the metals market did something that still doesn't feel real when you replay it slowly. A complex that normally moves in measured steps suddenly acted like a trap door opened under it. Reports describe gold plunging about 12% in a single session to roughly $4,786 an ounce, and silver dropping even harder before the entire move began to unwind. Not months, not weeks. In about 48 hours, prices tore through territory that would normally take a long season of trading to cover. And here's the part that breaks normal expectations. When you translate that kind of swing across the global stock of metal and the web of paper claims that reference it, the implied value that vanished and reappeared is not a rounding error. It's the scale of national budgets. Trillions of dollars of notional repricing, erased and then recovered so fast that casual observers were left with a headline and a shrug. They said markets don't do miracles anymore. They said liquidity is too deep, too electronic, too efficient for this kind of lurch to happen in broad daylight. But if you only saw the price, you missed the story. Because this wasn't just a metal falling and bouncing. It was a test of the machinery. It was a sudden compression of time where what matters is not what the crowd believes, but what the system forces. And in moves like this, institutions already know what they're watching for, while everyone else is trying to guess what happened after the fact. What I'm about to lay out isn't opinion, it's pattern. It's the repeatable sequence that appears whenever a market built on leverage, collateral, and paper claims collides with the physical reality underneath. Once you see the gears, the miracle turns into a mechanism. Welcome to the data ledger, where we decode what matters before it becomes dinner table talk. If you like analysis that follows filings, flows, and incentives instead of noise, settle in. Subscribe the way you'd take advice from the calm elder in the room, not the loudest one. And drop a comment with where you're watching from, because this story looks different depending on which side of the world you're standing on. Now let's reconstruct the event with forensic detail, because the details are where the leverage hides. The trigger, at least in the public narrative, was a policy expectation shock. A new round of headlines around the next Federal Reserve chair and the direction of interest rates hit the market like a hammer. In a world where nearly every asset is priced off the discount rate, a sudden belief that rates could stay higher or move faster changes everything. Gold, which tends to benefit when real yields fall and confidence cracks, became the pressure valve for that belief shift. Selling showed up across futures and related paper instruments, and it moved with speed that signals more than mere sentiment. Normally, a move like that would be absorbed. Dealers would widen spreads, volatility would tick up, and price would settle into a new band. But this time, the movement had the unmistakable fingerprint of forced action. It didn't look like a slow reassessment. It looked like liquidation, the kind where bids disappear, stops cascade, and the market becomes a one-way door for long minutes at a time. The phrase discovery doesn't fit a market when the first job is simply to find a bid. Silver's behavior made the abnormality impossible to ignore. Silver is smaller, thinner, more industrially connected, and historically more volatile. When gold sneezes, silver catches pneumonia. In this episode, silver didn't just catch it, it amplified it, as if the market was searching for the weakest link in the chain. That's not hype. It's liquidity physics. When margin calls start firing, positions in the most volatile instrument are often the first to be cut because they consume the most collateral relative to their dollar exposure. Then came the reversal. As quickly as the market fell, it began to claw back. Not because everyone suddenly loved gold again, but because the plumbing shifted. As prices fell into stress, the very forces that were selling became exhausted, while a different class of participants stepped in. That's the central mystery. How does a market go from free fall to recovery without a clean narrative change? The answer is that the narrative isn't the driver. The structure is. To understand why, we need to look backward, because this is not the first time metals have performed a fast collapse, followed by a stunning rebound. The playbook has been written across decades, and the actors change names, but the roles stay the same. In 1980, after an explosive run driven by inflation fear and geopolitical tension, silver famously spiked and then cracked, in part because exchange rules changed and leverage was squeezed. The aftermath wasn't just about price. It was about who could survive new collateral demands. The result was a brutal redistribution. The market didn't decide to punish anyone. The margin system did. In 2011, silver ran up again, fueled by post-crisis liquidity and a search for hard assets. Then, within weeks, a series of margin increases hit. Volatility surged and price fell hard. The pattern was clean. Rising price draws in leverage. Leverage becomes systemic risk. Risk triggers. Higher margin requirements and higher margins force the exit of the most leveraged longs. After the purge, the market stabilized, but ownership had changed hands. In 2020, during the early shock of the global pandemic, precious metals experienced a strange bifurcation. Paper prices wobbled and sometimes fell, even as physical premiums surged in refineries, and transport bottlenecks created real-world tightness. The system showed that price can mean different things depending on which layer you are looking at. The outcome was not a neat collapse or a neat boom. It was a lesson. When stress hits, the connection between paper claims and physical reality can stretch. And now, in 2026, it's happening again, but with a twist. The twist is that the demand base has shifted. This is not the same metals market of a decade ago. The flow sources are different. The global incentives are different. That's why the recovery looked like a miracle. The market wasn't healed. It was rebalanced by force, then supported by allocation. So who are the players in this chapter? Start with the exchanges and clearinghouses. Because in leveraged markets, the real power is often not the loud trader, but the quiet risk manager. Futures markets run on performance bonds, what most people call margin. When volatility rises, that required collateral can be adjusted. That's not mysterious, it's risk control. But the timing and scale of those adjustments can have enormous market impact, because they decide how many participants must reduce exposure immediately. Around this period, the core precious metals clearing ecosystem issued updated performance bond requirements with changes effective at the end of December 2025 and additional updates posted around late January 2026. That matters because collateral rules don't just describe risk, they create urgency. If requirements rise during a downdraft, the market can be forced to sell into the very weakness the rule is trying to contain. It becomes self-referential. Volatility increases margin, margin forces selling, selling increases volatility. Next, look at the official sector. For years, a major story in gold was the steady buying from central banks as they diversified reserves. But the data showed a shift, 3 tons. That doesn't mean central banks stopped caring. It means the marginal official bid was smaller than the year before, and that changes the market's shock absorbers. At the same time, investment demand surged. Reported investment demand jumped 84% in 2025 to around 2,175 tons. And gold-backed exchange-traded funds, the easy on-ramp for large pools of money, saw inflows reported around 801 tons in 2025. That's the structural shift. It tells you that price was being driven by broad portfolio reallocation. And portfolio flows can be calm for months, then decisive in a week, because they are executed by committees and models that flip from underweight to must-own when the macro inputs shift. Now add the banks and dealers who make markets in paper, gold, and silver, plus the bullion banks connected to London and New York. Their job is to, quote, hedge, lend, borrow, and arbitrage. In quiet times, they keep spreads tight and the system fluid. In stress times, they protect their balance sheets. But from inside the system, it's survival. When volatility spikes, risk limits tighten. When risk limits tighten, liquidity thins. And when liquidity thins, small imbalances become large moves. There's also a subtler player, the hedger. Miners, refiners, manufacturers, and large industrial users hedge to stabilize cash flow. When prices move violently, hedges are adjusted. Options get rolled. Delta changes. Margin is posted. These actions can add fuel at the wrong moment because hedging is mechanical. It buys when price rises and sells when price falls, not as an opinion, but as math. Then there are the vault networks and physical reporting bodies. London remains the major hub for over-the-counter precious metals, while COMEX is the price discovery theater for futures. Vault data can show large above-ground stocks still sitting in the system. London Vault reporting, for example, showed silver holdings on the order of 27,118 tons, with a modest month-over-month increase. To the casual reader, that screams abundance. So why would a market behave as if it's tight, even when inventories look healthy? Because inventory is not the same as availability. A vault bar can exist and still not be for sale at any price that clears the paper market. Bars can be pledged, leased, earmarked, or held by entities with motives that have nothing to do with short-term profit. And in stress, what matters is not the total number of bars, but the number of bars that can move at the price implied by the futures curve on the delivery schedule demanded by the contract. This brings us to the dislocation, the part no one is discussing with enough precision. There were 2 markets telling opposite stories, and both could sound convincing if you only listened to one. Market 1 was the paper market, futures, options, swaps, and the global price reference that moves on screens. This market can generate enormous volume because it trades claims, not necessarily metal. It is designed for leverage and speed. It is where stop losses and algorithms live and where liquidity can appear deep right up until the moment it isn't. Market 2 was the physical ecosystem, vault flows, refiners, transport, and the real delivery constraints that show up as premiums, delays, and location spreads. This market is slower, heavier, and governed by logistics. It is where you discover whether a promise can be honored on time. During the drop, paper prices acted as if demand had vanished. But the broader flow picture suggested something else, a structural bid from investment vehicles that had already been building. even as official sector buying cooled. That's the contradiction. If the world suddenly believed metals were worthless, investment demand would dry up and inventories would swell. Yet the trend in allocation demand pointed in the other direction. Here's where it gets interesting. Dislocations like that can't persist indefinitely because arbitrage is the whole business model of the middle layer. Either the paper market is correct and the physical world will loosen, or physical reality will assert itself and paper prices will realign. The miracle recovery is what it looks like when paper is forced to realign quickly, not because someone flipped a switch, but because the selling pressure that pushed prices down was mechanical and finite, while the buying interest underneath was larger and more patient. One more detail matters, because it explains why the move felt so fast. In futures, most contracts never become delivery. They are closed, rolled, or offset, which can create the illusion that the market is only about price. But the delivery framework is always there as a credibility anchor. Each delivery month has its own open interest profile and its own concentration of participants who are willing to stand for delivery versus those who are trading spreads. When volatility spikes, collateral requirements rise, and traders who plan to roll positions can be forced to cut them instead. It also matters that vault categories are not equal. Eligible metal can sit in a vault without being committed to delivery, while registered metal is positioned for the delivery process. In a stress event, the difference between those labels is the difference between comfort and scramble. If paper selling drives price down while the system quietly needs deliverable inventory to stay credible, you can get a strange mix of signals. Screens look weak, but the mechanics look tight. This is why timing can look coordinated even when it's shared incentives. A clearing update lands, brokers update requirements, risk systems recalculate. The most levered accounts get calls. They sell what they can, where they can. Meanwhile, allocators watching the same screens see a discount created by forced flow. They don't need to predict. They only need to recognize that forced selling ends. Today. Now let's put numbers on the evidence because numbers force clarity. First, the central bank shift. 3 tons in 2025, down about 20%, tells you the official sector was less dominant than before. Central banks are typically less sensitive to daily volatility. They buy for reserves. They can be the ultimate slow hand. When they're buying moderates, the market becomes more sensitive to other flows. Second, the investment surge. Investment demand reported at 2,175 tons, up 84%, tells you that the marginal buyer became the investor class. Investors respond to yields, currency moves, and risk. They can be fast. They can also be huge because modern portfolios are enormous. When that class decides to allocate, it can overwhelm ordinary liquidity. Third, the ETF inflows of roughly 801 tons in 2025 tell you the reallocation was not a rumor. It was executed. An inflow of that magnitude represents a lot of exposure that must be sourced and allocated, or at minimum hedged against, which tightens the ecosystem even if the bars don't visibly leave a vault. Fourth, the margin system. Updated performance bond requirements around the end of December and late January matter because they define the stress threshold. If margins rise, the same position requires more collateral. For someone running leverage, that is a forced choice. Post more cash or reduce exposure. When thousands of participants face that choice at the same time, price doesn't drift. It jumps. Now, what does all of this mean? It means the move wasn't a simple verdict on metals. It was a collision between rate expectations and a market structure that amplifies shocks. It means the recovery wasn't magic. It was the point where forced sellers were cleared out and structural buyers were still present. It means the market was revealing who had to act and who could wait. And historically, when that happens, the next phase is not decided by one headline. It's decided by whether the system tightens or loosens collateral conditions and whether physical availability stays aligned with paper promises. This is the part most people miss. A leveraged market doesn't simply reflect reality. It manufactures urgency. The contracts are promises with clocks attached. The clearinghouse is the referee. When the referee changes the required collateral, the game changes instantly, regardless of anyone's long-term thesis. Think of leverage like a spring. In calm markets, people compress the spring because it looks safe. They borrow, they stack exposure, they assume they can unwind if needed. The spring is fine until the room shakes. When volatility spikes, the spring releases. That release is margin. Margin is the system saying, the room is shaking. If you can't, you must reduce the spring. Now imagine thousands of springs releasing at once. Selling becomes synchronized. It doesn't matter if a participant believes gold is undervalued or overvalued. If their broker demands collateral and they don't have it available, they sell. Often they sell what is liquid first, and in metals, the most liquid paper instruments can become the dumping ground. That dumping creates a price decline. The price decline triggers more margin calls. The margin calls trigger more selling. It becomes a loop. Then the loop hits a wall. The most leveraged participants are gone or reduced. The remaining participants have stronger balance sheets, or they are buyers who were waiting for a better level. At that moment, the market stops falling, not because fear vanished, but because the forced component ended. The rebound is often violent because the market was pushed below the level that patient buyers consider fair. When bids return, the lack of selling creates a vacuum upward. That's what a miracle often is in finance. The end of forced flow. There's another layer too, geography. The paper price is global, but physical demand is not evenly distributed. Jewelry demand, industrial demand, and reserve demand concentrate differently across regions. In stressed moments, flows can tilt. Metal that is in the system may be in the wrong place, in the wrong form, or under the control of an entity that won't part with it. That's when you see odd signals, futures down, but premium steady, spot down, but delivery. Schedules tight, headline bearish, but allocation quietly building. So the forward analysis is not about predicting a number on a chart. It's about understanding what historically follows when this exact pattern appears. If volatility remains high and margins continue to be adjusted upward, the market can experience additional liquidation waves. That scenario is conservative in the sense that it assumes the system prioritizes risk reduction over smooth price discovery. In that case, prices can remain choppy, with sharp rallies and sharp drops, as leverage is slowly wrung out and participants learn what their true risk tolerance is. If volatility stabilizes and margin requirements stop rising, the moderate scenario is a rebuilding of positions by the investor class that has already shown it can deploy size. In that environment, prices tend to grind higher, punctuated by sudden dips as the market tests liquidity, but the path is more constructive because the buyer base is structural and the selling is less forced. If, however, the paper-physical dislocation widens, if premiums, location spreads, or delivery tightness intensify, then the aggressive scenario is not a straight line up, but a repricing of what paper claims are worth relative to deliverable metal. Historically, when trust in smooth delivery is questioned, the market can gap to restore confidence. It's not guaranteed. It's simply what has happened when the system needs to close a credibility gap quickly. What should be watched is not vibes, it's indicators. Watch the pace of ETF flows because they represent steady portfolio demand rather than impulse speculation. Watch official sector reserve behavior because it can either damp volatility or leave the market to faster hands. Watch margin notices and clearinghouse updates because they tell you whether the system is tightening the screws. And watch the relationship between spot prices and physical premiums or location spreads because that's where paper reality meets logistics. Now we arrive at the choice ahead, and it's not a choice of ideology, it's a choice of attention. There are people who treat markets like stories and people who treat markets like systems. The story crowd waits for a simple explanation, then reacts. The system crowd watches plumbing, flow, and constraints, then understands why price moved before the headline made sense. The divide isn't about being smarter, it's about being earlier. In almost every major market dislocation, institutions move first because they are wired into the incentives and the rules. Retail moves last because retail is wired into the narrative. That information gap becomes a wealth gap, not because anyone is evil, but because the order of operations is built into the market. So when you hear miracle recovery, translate it. Ask what was forced, what was structural, and who was on each side, because that's the real signal. This is the data ledger, where we decode what matters before it becomes the headline everyone repeats. If this connected dots you hadn't lined up before, you know what to do. The question isn't whether markets will keep testing the edges of their own structure. The question is whether you'll recognize the mechanism before the next move compresses time again.